So guys, I hope you have understood the last concept what we discussed in time value of money. That is, we were understanding on how to compute net present value and the interpretation of NPV and how to interpret IRR. IRR calculation we have seen. More than the calculation, it's the meaning of IRR that is more important. IRR basically refers to the actual return what you are earning from the project on compounded basis. That is IRR. And then we have understood the same project evaluation decision from a different angle called as valuation perspective. Why we have discussed this is, we have chapters on valuation of bonds, valuation of shares, valuation of businesses. In all this, there is one commonality, one common feature that runs along all these chapters, that is this valuation perspective. So today, we'll start a new topic, sir, which is bond valuation. So guys, this chapter weightage is around sometimes 8, 10, 12, very rarely more than 12, but maximum 10 to 12 marks. People who are attending from CMA for CMA final, you attend today, tomorrow and next day. 3 sessions, sir. After that, whatever we discuss here, that should not be relevant for CMA final, but CA people, you should stay all through, okay? So if any CMA students are there, you should, first 2-3 sessions itself is very more than enough for you, because in your syllabus it's hardly 2 pages only. So on that also, questions are not very vividly asked, but just whatever they printed in the 2 pages also, if you have to understand, you got to attend these 2-3 sessions. Okay. Sir, listen, bond valuation, I'm telling you before only, the chapter is very easy in the starting stage. First 2-3 classes or 4 classes maximum, you will really find it going forward. You with a little difficulty, but you will understand. Slowly things start settling in. At that time, little advanced concepts are there. They are also easy only, provided your basics are good. Sir, basics means IPCCR. No, today, tomorrow, day after. If these 3 days are good, then 4th day onwards, you are still in game. Otherwise, I will be in some world, you will be in different world. So let's try not, let's say, together that should not happen. So there are some concepts in bond valuation which are genuinely complicated. Genuinely they are complicated, that people also normally will not discuss, and many books also concepts will not be written. But as long as a little bit about that is mentioned in ICA material, we cannot take risk with that. Correct, sir? So just because ICL it is there, we have to discuss. There is no other reason, whether it's complicated or easy or tough, that's the secondary story. Study matter there, we have to cover that. So like that only, if you see there are many concepts, and bond valuation, even though the concept is very small, the depth of it is very high. So enough of introduction, let's go straight into the matter. Now, what exactly is the meaning of a bond is? Bond is nothing but a debt instrument issued by entity to raise funds. Bond means nothing but a normal debenture, sir. In fact, to make it more simple, you will understand the term debenture more comfortably. So whenever you say company issued debenture, what you understand is something, a security which is like a share only, it will also have a face value. The company will issue this paper to the investor. From the investor, we collect money. And this bond or debenture, it will have some maturity period of 5 years or 8 years or 10 years, some maturity period will be there. Throughout the period, the company goes on paying interest every year. One day, once the bond last day comes off, the company will pay the principal amount also, and that we call it as redemption of bonds. So for this debenture, issue of debentures entries and all you must have studied in your basics. Redemption of debentures chapter only was there. This concept is about that debentures only. Only thing is, we are not going to learn accounting obviously here. We will try to learn the valuation of it. That means a bond ki how much value we can invest. If you are already having that bond, should I continue to hold that bond or should I sell the bond? If I buy this bond, how much return am I going to get? This sort of bond side analysis we will be doing, sir. Now, sir, when bond is a debenture itself, then why to call it as bond? You better call it as debenture only, no? Of course, we can call it as debenture only. There is literally no difference. Now who will issue bonds? And a question, if you think, any company which is in need of money can raise money through bonds. If public sector companies or government undertakings, if they are issuing debt instruments, generally they are referred as bonds. Normal corporate companies and all, when they issue debt instruments, we refer it as a debenture. As such, in substance, they both are literally same, sir. Bond, debenture and words interchangeably, royally you can use. That is 100% correct. Okay. Now, coming to a bit of background about this. Suppose any company which wants to raise funds in the long term, they basically have two main sources, sir. One is equity, the other one is debt. Equity means the company issues equity shares, raises money. Equity share one advantage is there. That advantage is first I take money. There is no fixed commitment you have to deliver. That means every year compulsory interest, compulsory dividends and all you need not pay. Of course, they will have certain expectation. You need to fulfill that. But explicitly, you need not pay them any cash and all every year. That's about equity share capital. On the other side, if you think about debt, debt means it's nothing but a borrowing, sir. Debt is nothing but borrowing. Now, e borrowing lo, again, two routes are there for the entity. One is take a loan from a bank or any financial institution. Raise a lump sum money from a bank and you go on paying interest till the life of the loan. After 5 years, 10 years, 15 years, 20 years, or whatever period loan you have taken, you repay the principal amount. This is one way, sir. There is another way, that is issue debt securities or debt instruments to investors. Sir, you go to a bank, ask money from the bank. Bank, if it is satisfied with the project for which you are raising money and all, bank will lend you money. Looking at your face, some risk will be there, or risk, some interest rate they will charge, and they will give you money. Now, where is bank getting money from? Public. The general depositors' money only, bank will again lend it to all these corporates and all. Now, imagine there are some set of investors who are well informed. That means you are not an ordinary investor who doesn't have any knowledge about business. At least you people who are sitting in the class, you all know how things function, where bank is getting money from, where bank is giving this money to. When any company is in need of money and they say that we want money for our project, and if you already know about that company, if you feel that the management is ethical management, they are very successful entrepreneurs, if you have such feeling, you also may want to lend money directly to the company itself. Sir, why? Why means simple, sir. You go and invest money in bank, what return will you get? 6.5%, 7%, 8% maximum. That's good FD you have to put. Correct, no? Other you go and invest in debentures, generally, a normal decent company will give you at least 9.5, 10%, 10.5%. So, investor, why should I give money to bank? And bank again is ultimately going to give to money to that fellow only. Instead of doing that, I give money directly to the borrower itself, the company itself, I lend money. For that, the company will directly pay me interest. This is called as a debt market, sir. A market is between the who and who, the company and the investors directly. Now these people here, they are gender equality, sir. Otherwise, some people will raise voices. Now, see, sir, the company issues debt instruments to general investors, and these people, they pay money to the company, and company will issue to them a debenture or you call it as a bond. Now this fellow, I'm zooming in this boy, he is holding a bond, sir. E bond there will be one face value, there will be one interest rate, and there will be one life. So face value will be defined on the bond, interest rate will be defined, and redemption date also will be mentioned. Now, sir, what can he do with this bond, this investor? What he can do is, he is holding the bond now, hold like that only. Every year, the company will keep on paying you what? Interest. Receive interest. How many times you will receive? 5 times you will receive. If it is annual bond, 5 times you will receive. At the end of 5th year, the company will snatch that paper from you, they will give you your money back, and bond life is over. Sir, I am having my money back now, what should I do now? Go and find somebody else who wants money, go give money there. The process continues. This is one way, sir. There is another way, means another choice what an investor can do. After buying the bond, hold the bond till whatever time you want to hold. After that time, if you want, you can sell the bond also. Let us say, this guy is A, B, C, D, E, and F. All these people invested in the bonds today. All these people got allotment. Mr. A also got allotment. Now, after few days or after few months, A wanted money back. A straight went to the company, told the company that, company, do you remember my face? They say no. Then this fellow shows this bond certificate and all. See, I gave you money 6 months back when you were in need. I want money now. I am in need. Give me back my money. Will the company give? What the company will say? Arey, come here. E bond paper what is written? 5 years. Elpo 5 years. Sarat you come back. I will give you. Not today, because there is a maturity date, sir. Before the maturity date, nobody is going to give you any redemption money back. At the maximum, you can ask for what? Interest payments. You can ask nothing more than that. Now, this fellow wants cash, he has an asset, but he is unable to convert that into cash. That creates a problem of liquidity. To erase this problem of liquidity, usually what the companies do is, they go and list their bonds on stock exchange. List the bonds on stock exchange. When you list the bonds on stock exchange, what happens is, all these existing investors and the new investors, they have now found a place to meet and transact among themselves. For example, A is having bond, he wants to sell off bond, our way. Now, there is some H. He wants to buy bond of this company, but company is not issuing any bonds right now because issue is already over. They raised the money what they want, they invested also. Today they are not in need of money, they will not issue any bonds. But this fellow desperately wants bonds of this company only. There is another fellow who desperately wants to sell the bonds. Now, only thing I have to do is make A and H meet. That happens when you list the bonds on a stock exchange. Of course, they don't literally meet each other, they go on a date and all, that will not happen. It's just that you will be knowing which party is willing to sell and which party is willing to buy. Sellers and buyers you will know. That's all. What name, what male or female, where does he stay, age, nothing you will know. Bond ka price will be there. You will know whether the bond is liquid enough or not. If you want, you can sell the bond. If there is any other counterparty who is also willing to buy the bond at the same price, then the transaction can be executed. That means it is possible that investor to investor transaction happens. So this fellow sells bond to H and H pays the money to A. Because of this transaction, what happens is A, who is the original investor in the bond, he is selling off the bond, and in place of A, who is joining the team now? H is joining. So like how A got replaced by H, is it possible that B also, C also, D also, E also, F also, they all can be replaced? Possible or not possible? Possible. Whenever they sell their bonds, automatically they will no more be the investors of this company. Some other new people will be the investors of this company. That means the investors of the entity, they keep on changing. They keep on changing. Sir, why sir? Because of buying and selling. Buying and selling is happening among the investors themselves on the stock exchange. Now there are two words for it. Now, first time who issued bonds to who? Company issued bonds directly to the investors. This is called as a primary market, sir. This is called as primary market. Once bonds are issued to the public, now the public, whatever investors are there, if these people want to sell the bond to another investor, that they can do it on a stock exchange. It is second-hand market, sir. That's why we called it as secondary market. Sir, market means what? As in market, what is there? Sir, it's simple, sir. Market is nothing but there will be three things importantly: buyer, seller, and the asset which is actually getting traded. Here, who is the asset that is getting traded? The bond is the asset that is getting traded. Sir, bond is liability. No, bond is liability. For whom? Company, there is liability. People who are trading here is not company. No, people who are trading here is investors. For investors, the bond is a asset. So, asset is getting traded. There should be a buyer, there should be a seller. There are so many buyers in the market, so many sellers in the market. Sorry, market, which area it is there? This is not a physical market, vegetable market or fruit market to be there on a particular area. No, sir. This is a virtually connected market. Stock exchanges are there. You can access the stock exchange via your stock broker. Once you open a demat account, you will be given access to that. So you can see which shares are available, which bonds are available, which one you want to buy, which one you want to sell. All that sitting at here you can do. Okay, so that's how you will be connected to the market. Now, in the primary market, A, B, C, D, E, F, whoever are the investors, these are all buyers, sir. Who is the seller in the primary market? Company. Who is the seller? Is company only is the seller. But once these people who got the investment from the company, once they enter into secondary market because of the listing that happens on the stock exchange, these people only will now become sellers and the other parties will become buyers. Like that, bonds keep on changing hands up. Sir, how will the company pay interest, sir, if everybody is holding for 2 months, 3 months, 1 month, 6 months? So how will the company know to whom to pay interest and how much to pay interest? Company will not bear all this nonsense, sir. What company does is, they will already mention the due dates of interest. Our due date, whosoever name appears in the register of debenture holders, that fellow will be getting the coupon amount or interest amount. That's it. The company will not keep a track of how many days did you hold. Proportionately, they will not compute and pay interest to you. That and all will not happen. Now, how that works between investors to investors, that we will see as we go further. Okay, sir. Now, every bond has something called as face value. If face value can be anything, sir, there is no restriction on how much can be face value. Face value can be 100 rupees, it can be 1000, it can be 10,000, it can be 1 lakh face value bond also. There, it is possible that bond can have any face value. If face value A, also called as nominal value. It is also called as par value. These are the same names, sir. All the three, they indicate the same thing. Nominal value, face value, par value, they all are the same stuff. Now, sir, face value, is it representing the real worth of the bond? And the answer is no. Then what is the relevance for this face value? The relevance for this is, a bond, like how it has a face value fixed like that, a bond also will have a interest rate. Be very cautious to not use the word interest rate in relation to bonds. That's interest rate, but you don't call it as interest rate. You will rather call it as coupon rate. Is the right word. Debenture with whatever interest rate the debenture pays, the bond pays, that's called as coupon rate. Sir, what is coupon rate meaning? Interest only. Then why are you not calling it as interest? I'm not calling it as interest because generally if somebody says, sir, interest rates increased, interest rate decreased, you will get confused, sir. Once I issue bond at a particular interest rate, A bond ka coupon is not going to change. But market interest rates keep on changing. If anybody says interest rate changed, they are not talking about your bond ka interest rate. They are talking about in general market lo risk-free rate interest rate. That is the reason that also you go call it as interest. This also you call it as interest. You unnecessarily land in confusion. So whatever interest rate you offer on the bond, we will call it as coupon rate. In fact, all the questions also refer like that only. Now, if you want to calculate coupon amount, means interest amount, what the company pays periodically, what you have to take is take the face value, and on that you have to apply the coupon rate. I know that this is appearing very basic to you, but it's good that you already know this. So for that reason only face value is defined, sir. Without face value of the bond, we will not be able to solve any sum. In fact, face value is very important. Not because that's the value of the bond. It is that value on which interest amount is computed or coupon amount is computed. Now, every bond will have a maturity value also. Maturity value means if you hold the bond till its end of the life of the bond, a last day ki whatever the bond pays, ade maturity value. A maturity value can be at par or at premium or at discount. Maturity can have, for example, the face value is 100. Redemption value also can be 100. It can be 105. It can be 95 also. It depends on case to case basis. In this, one important point is, if nothing is mentioned about maturity value, assume it as par value. Par value into nominal value, ade face value. So maturity value will generally be par value only unless the question talks otherwise. Normally you have to go with a fundamental assumption that maturity value and par value both are same. Now, what is the meaning of bond valuation? Now, bond valuation means it is the process of calculating the fair value of the bond. You determining the worth of the bond is called as the bond valuation. It's a process of calculating the fair value of the bond. Because if you want to write, you can write parallelly whatever I'm writing, but as such, theory and all is given in the material. So even if you do not write also, it's okay. So don't think that you are copying and you are also having the pressure of listening and all. Don't take that pressure. Materially, everything is there. So if you're able to write, you write, or else it's fine. Forex, I made you write wantedly, sir, because the chapter nature is like that. This is not like that. Anyway, next question. Sir, how to compute fair value of the bond? Now, yesterday, if you remember, we were trying to discuss valuation of a particular machine or a project. Our project ka life was 3 years. The project was giving cash flow of 10,000, 10,000, 10,000. Before I went to the market and identified the market price of the machine, the first calculation I did is, at my home, I did fair value and I started. Now, how did I get that fair value? Present value of all future cash inflows discounted at required rate of return. Same story, sir. Fair value of bond is nothing but present value of future cash inflows from bond. Whenever you say present value, you should make effort to think that if I have to compute present value, which one should I use as the discounting rate? So in this case also, discounted at required return. So future cash flows and required return. These two things will influence the price of your bond or value of your bond rather. We will now apply this formula, try to get some value and interpret it more clearly. But before we go there, the fair value of the bond is also called as theoretical value of the bond. If somebody asks you, compute theoretical value of the bond, means you did not look at fan, wall and all. Theoretical value and fair value, they both are same. Not only that, in some areas it is also called as intrinsic value of the bond. Some people may also call it as equilibrium value of the bond. So if the question asks any of these, you have to do the same thing, fair value calculation only. Now, sir, example, a small diagram we draw, one small timeline. This is a coupon paying bond. Coupon paying bond means a bond periodically gives interest, sir. So let's say the bond life is 1, 2, 3, 4 years. Now you look at the fair value definition. I told you we need two components. One is inflow, the other one is required return. Tell me, sir, bond will give what inflows? If you buy a bond as an investor, what inflows are you looking at? Interest every year, then maturity value, and correct now. So here you will get coupon amount. Here also you will get coupon amount. Here also coupon. Here also coupon. So you will have 4 coupons because the life is 4 years. Plus lastly you will have one maturity value. What I want is, I want to know the fair value of bond. Sir, how to get this? What is the principle? Discount all those cash flows to today using a required rate of return. Now, all these cash flows go discounted to today. We know how to compute present value when cash flows are given, discount everything, whatever final answer you get, adhe fair value of the bond. So this is formula type lo if you want to write this. It is thinking, sir. This is how your mind should work. But solution lo, mathematically if you want the answer, it is like this. Coupon every year it's coming in this example, correct? It's coming every year with equal intervals for limited period of time. This is a regular annuity cash flow. So coupon into PVIFA RR. How many years? 4 years. Don't see and tell. Next. Maturity value into PVIF RR. 4 years of 4th year of 4th year. You already know how to work out PVIF and PVIF, correct? No? Coupon amount, coupon rate question will give you. Dump everything into that, one answer will come. Adhe fair value of the bond. This is the first example, sir. Yes. I have to address only one more question. That is, how will I know which one is a required rate of return? Yesterday, we were doing a project evaluation case where I borrowed some money from debt. I got some money from equity. The money I am investing in a project. So what is the required return means? There you considered weighted average cost of capital. But is this a project? I am an investor. I am an ordinary investor. Out of my savings, I have invested some money in a bond. Now what is required return? You should not shout whack whacken because there is no whack here. I don't have monies borrowed from somewhere. I don't have equity share capital. I am an ordinary investor, sir. Yesterday's samlo, who was investor is company was investor. Company was investing in a project outside. So the company ka required return from the project we were discussing. What is this one? An ordinary investor investing money in the company, how much return he wants from this bond, adi RR here. So whoever is valuing that fellow's RR, you have to consider. Sir, ERR, how will I get? We will discuss that. Before we do that, answer this one also. Example number 2. Zero coupon bond. What is this, sir? Zero coupon bond means. See the name itself. Zero coupon means this bond is not going to pay you any interest at all. Okay. Now, suppose, sir, a bond is issued by a company whose life is, let us say, 5 years. Sir, next 5 years, what will I get, sir? Nothing. You will not get anything. Sir, then 5th year ending, what will I get? You will get directly the maturity value. I want to know what is the fair value of the bond today. Your concept is simple, sir. Whatever future cash flows are there, discount. The one cash flow, you will discount. 10 cash flow, 10 cash flows you will discount. In this case, it's only one cash flow, just discount it. Discount at required return. So fair value of zero coupon bond is equal to maturity value into PVIF RR, which year? 5th year. Sir, is PVIF correct or PVIF A you should write? IF is correct. Okay. One general doubt, sir. If a company is not paying any interest at all, why would I buy the bond? This bond is issued at discount prima facie. Because if I tell you that maturity value is 1000, today also you will buy the bond at 1000. No. 1000 ka present value. 1000 ka present value 5 years ki, it will be some 600 rupees or 700 rupees. So today I buy the bond at 700, hold the bond like that only for a period of 5 years. Company will directly mature or redeem the bond at 1000 rupees. So gap whatever is there, that entirely becomes my income. Sir, are you getting income cash flow every year? No. Cash flow only once I will get at the life end. Is zero coupon bond. Answer, one more example. Perpetuity bond or perpetual bond. So you'll get coupon here, coupon here, coupon here, here, and like that you go on getting, sir, till infinity time. Sir, when will this bond be redeemed? Never. Bond will not be redeemed at all. Sir, how to get value of this? What is there? See, there are so many formulas or so many principles. Principle ఒకటే ఉంటుంది, sir. That is, discount all the future cash flows to today's date at required rate of return. Tell me, sir, which formula should we apply now? Is it a perpetuity or not? It is a perpetuity. Level perpetuity or growth perpetuity? Level perpetuity. Since it's a level perpetuity, what is the formula? Fair value of bond is equal to coupon amount divided by, good, very good, coupon amount divided by RR. Yesterday when we were doing level perpetuity formula, I told you CF1 divided by PIR. Bond flavor you have to add now. CF1 is nothing but coupon amount at the end of first period. PIR is nothing but your required return here. That's all. You'll have your answer. Now, because we already completed time value of money, if formulas and all are appearing quite simple to us. Otherwise, you have to remember all this. Now, this formula you only derived, this one also, this one also. Like that, many formulas you'll be seeing hereafter as well. Anyway, keep this aside now. Let's try to understand bond, or if I have to do fair valuation of the bond, as seen in the formulas, I need two ingredients basically. One is future cash inflows, the other one is the required return. Future cash inflows, sir, only two types, sir. Either you will have coupon amount and you will have maturity value. Sometimes what will happen is your coupon amount will be 0. You will have only maturity value. Which case? Zero coupon bond. Zero coupon bond is that case where you will not have coupons, but sometimes in other bonds you will have coupons. Now coming to this one, sir. It is a very dangerous discussion, very important as well. Now, sir, coming to required return. Required return basically means we are talking about how much return investor wants from the bond. That is required return in this context. Yesterday's discussion, time value of money, end, flag and low. What we were doing is, sir, don't get confused because it's very important. Later on confusions will come. So before only we are putting the efforts. This company, sir, let's say X Limited. X Limited has money raised from equity and debt. X Limited is now investing this money in a project. While making project evaluation, who is investor there? Ordinary outside investors are public or company. So company is the investor. When company is evaluating this project, they will discount it using a required return. Our required return will be weighted average cost of capital. It doesn't mean that everywhere RR is WACC. If company is investing in a project, company RR is WACC only. But in this case, are we valuing project, bond? Bond. Bond who is investing? Company is investing, outside investors are investing. So this fellow, look at this. This boy who is standing here, he is investing in this debt. Is it right? Now what this fellow wants are the RR, E-sum ki or E-chapter ki, this will be your RR, sir. Sir, yesterday we discussed from company point of view, yes, because yesterday discussion lo company is the investor. Today's discussion, who is the investor? A ordinary fellow is the investor, retail investor. So this fellow's point of view, RR we are trying to work out. Are you understanding, sir? Wherever you go, you think from company's point of view or investor's point of view, RR is required return from the investment made. But that RR is which one? How to compute that? That changes depending on who is the investor. Is the individual investor is making investment in bond, or the company is investing money in a project? Depending on that, the mode in which you compute the discounting rate will change, but nevertheless they all are called as required returns only. So now that you understood, I'm just removing this. Okay. This required return depends on two things. One is risk of the bond. The other one is market interest rates. So how much return an investor will desire depends on two things. One is the risk of the bond, the other one is the market interest rates. Sir, how risk of the bond will impact the return required by the investor? General common sense only, sir. Suppose you are investing anywhere where there is very high risk, but still you want to invest there. Tell me, sir, you will expect high return, low return? High return. Because you are taking extra risk now. For that extra risk taken, you want some compensation or premium. Premium means extra. So a extra return and normal return both put together, you demand a very high return. Or rather I should write high RR. Low risk, you are happy with low required return. Ideally you should be happy with low required return. You should not say, I will take least risk but I want highest return. Not possible, sir. Even theoretically also not possible. See, our valuations and all are reasonable, fair calculations. Sir, I am investing somewhere where there is no risk at all. Government of India bonds I am investing, sir. Not Reliance company bonds. Not the Adani group bonds. Sir, that is also as good as investing in government only. No, sir. No stupid jokes. Now listen. You invest in any corporate bonds, there is risk. You invest in treasury bills issued by RBI on behalf of Government of India. That's absolutely risk-free investment. How much return will you invest? I expect. No risk means no required. Na? Low already over. No. I already told you the answer, stupids. You should expect risk-free return. There's something called as a risk-free return. For not taking any risk also I want some return. That is RF. You take little extra risk, little extra return you demand. You take more risk, more extra return you demand. So overall your returns keep on increasing. We'll come to market interest rates in a while. Let's first finish off understanding the risk and return relationships. Suppose, sir, you are having lot of money with you. You don't know what to do, but you will not donate to anybody. You want to lend it to someone. In front of you, two parties are there. This fellow also needs money. Little small fellow, he also needs money. He is CA, sir, qualified. This boy, CA final, almost qualified. Both are asking this boy, this lender, to invest 1 lakh rupees. This fellow has 1 lakh rupees, sir, surplus. He wants to lend either to him or to him. Now, between these three, who are you? And don't say CA final student. You are this. No. You are this, sir. This person. You are not somebody who will put hand like this. Joke. Okay, this. Now, tell me, sir. To whom will you give money? Other question. CA. All of you will give money only to CA. You will give money to CA final student. No. Ideally, you should not give money to CA final student. Correct? No, sir. There is one inherent risk. Or will you say that, no, sir, I am student, I know the pain. So if CA final student is asking money means, I will give, sir. I am partial. Yes, sir. I will take the stand. I will stand for him. So even you put untai, sir. Sir, you all know how your bosses treat you in office. Correct? No. Your boss also once upon a time was CA final student only. But today, is he behaving like that? Does he remember all that? Nothing. Like that, you also will become like that only. So, don't have any feeling towards CA final student. You will definitely give money only to CA. Why? Reason is you feel that their risk is relatively lower. But sometimes, giving money to CA is also risky. Why? That fellow is too intelligent to cheat you. Once he passes, he will give it off. That fellow knows 100 ways to not to give you money. Possible, no, sir. That is also one risk. Anyway, jokes apart. Now see here. He offered 10% interest. Who? CA. This fellow also offered 10% interest. Now what you did is, giving money to his CA is better because both are offering same return. I would rather prefer less risk. This fellow's ego got hurt now. He said, 13% I will give money to me. How I will give you don't bother, but I will give you 13% interest, give money to me. Now, this fellow is really thinking now. Till now, the decision was very clear. We should give money only to CA because both are offering same 10%. But once giving money to CA final, which is quite risky thing, for that risk, this fellow is also throwing extra biscuit also. What is that? Extra return. Now this fellow is really thinking, should I not take extra risk and happy with 10% or take that extra step of risk and earn 13%. So less risk, less return, more risk, more return. A simple example is this. Now we'll take a little proper example with valuation with numbers. Sir, there are three entities. One is Government of India undertaking. They are issuing a bond. ఈ బాండ్ లైఫ్ ఈజ్ ఓన్లీ 1 year. After 1 year, they will give you 1,000. Ante future cash flow. There is no other future cash flow, only 1 year. Sir, why are you taking 1 year bond? Sir, let's take 5 years bond. It will take more time, that's all. Easy to understand. Next company is Reliance. Almost government in India, but not exactly government. They are also issuing 1 year bond. After 1 year, they will also pay 1,000. This is some X Limited, formed 2 years ago only. Last 2 years they made quite decent profits. They also want money. They are also issuing bonds today. Life 1 year only. After 1 year, they also will give 1,000. Now tell me, sir, among these three, who is more riskier? X Limited. Who is absolutely risk-free at all? Government of India. Who is riskier? Reliance Limited. You should not say, sir, Ambani is very rich. No, sir. That is also risk-free. No, sir. Look at second Ambani. He is also Ambani only. But you know how much debt he has and he is unable to pay today. See, this debt is not raised by Ambani in his personal capacities. They are raised by the corporates. Companies raise, and companies have limited liability. The company does not perform well, a debt and all will not be paid. So there is a risk side. You are not giving money to Ambani to his personal family. Why will he ask you? His company will ask you. And a company may not perform well. And companies are with limited liabilities. So if the company goes into losses and the shares are fully paid, you can only sit and cry there. Nothing else you can do. So risk is always there with all these companies. Government of India, though, advantage is, government will not go bankrupt generally. That too in a country, developing country like India, governments do not go bankrupt. They may have huge debt, but they will not go bankrupt. They will have enough money to discharge all their commitments. And that too, if any government has defaulted in any payment on their government securities and all, international market law, a government ka value will be falling down, sir. So governments will not take risk in defaulting any of the payments. When you default your government security with payments and you go to IMF or somebody else in the international parlance and ask money from them, they will charge a very, very high interest rate. Because you are somebody who already defaulted or delayed the payments and all. So government side generally defaults gani, delays gani will not be there, sir. Anyway, just for the sake of it, I am telling you. Here, since risk is not there, the investor is happy with just 8% RR. 8% if you give me, I will give money to you. That's what investor is telling. Reliance is riskier, no? So, but investor says, Array, even though you and government are best friends, but still you are not government. Therefore, I expect 12% from you. X Limited is doing the same business as Reliance Limited. He is asking, sir, I will also offer 12%. No. You formed yesterday only, 2 years back. This company is there since some 30 years. So I don't trust you much as I trust Reliance. So here the risk is even more. So I demand 15% return. Now you observe, sir. All the three bonds ka life same, cash flow same, but risk levels are different. Because risk level is different, required return is also different. And because of that, your fair value also will be different. Now tell me the fair value of each bond. This you have to discount by how many years? All 1 year only. So 1000 divided by 1 plus 0.08. You can multiply with PVIF also. 1 year ago I am doing like that. 926, huh? Leave chiller, no, 926. 1000 divided by 1.12. It's 70, yeah? You observe, sir, there are 3 bonds in issue. All the 3 bonds ka life same, future cash flow same, but how much you should invest today is not same. You see, sir, you want to earn a return of 8% from this first bond, go and pay today 926. Sir, what if I pay 930? You will not get your 8%. You want 8% return? Buy this bond at 926. Reliance bond, you are expecting or you are demanding a return of 12%. So you should buy this bond at 893. Sir, what if I buy at 900? You can buy at 900 also. Only thing is you will not get your desired return of 12%. You want to earn your desired return, you go and buy the bond at the price which I am telling you. Ide fair value, sir. Fair value is that value which will give you your desired required return. So EX Limited is also issuing one bond. If you want to buy this bond, you can buy this bond at 870. If you buy this while X Limited bond at 870, then you will be getting your desired required return of 15%. From this, what one can establish is risk and required return both are linked, sir. Based on that only required return is decided, and based on required return only bond prices and valuation is also getting dependent. So all this is linked. Now, coming to next question, a little with more clarity. Sir, you gave 3 examples like Government of India bond, Reliance bond, X Limited bond. These 3 are very plain cases where anybody can answer who is more riskier, who is less riskier and all. But if I am a real investor in the market and some company is issuing bonds, how will I know the risk level of that company? Here and there for your comparison, I gave you Government of India, Reliance and some other company. So on a comparative basis, you told compared to Government, Reliance is riskier. Reliance country X Limited is riskier. So you are able to understand the risk on comparison basis. But I tell you that there is Tata Motors. They are issuing debentures today. From these debentures, how much should be the required return and how will I know this? For that, there is a separate exercise, sir. There is something called as credit rating. Credit rating means, sir, as an auditor, what we do is after doing an audit, you issue an audit report, correct? Audit report lo what you will sign is, after doing so much of work, we believe that the financial statements are reflecting a true and fair view. And our opinion will express. Or they are not reflecting a true and fair view, an opinion will express. And we sign on that. Like how we express an opinion on the true and fair view of the financial statements, like that, there are independent organizations like CRISIL, Standard & Poor, CARE, Fitch Ratings. These are all companies independently formed credit rating agencies. What they will do is, they will take all the financial data of Tata Motors Limited and they will express an opinion on the risk level of Tata Motors Limited. And that expression will be like this: AAA, AA, A, BBB, BB plus, like that, the ratings, sir. AAA rating is considered as the highest rating. Highest rating. Your money will not be defaulted at all, and your confidence that independent organization is expressing. As you come down, slowly, risk increases, so rating is coming down. Of course, some companies express ratings like this also. A, small a, two small a's. Like this also ratings are there. That means depending on which company is doing, accordingly their rating scale will be there. For each of that, interpretations are there again. Anyway, so one will look at these ratings. For example, Tata Motors has been given a single A rating. Oh, single A rating. That means risk is there. Considerable, not very high risk, but considerable risk is there. So, A rating on a company, how much required return is there, an investor will think and he will desire accordingly. So, depending on this credit rating, investor will understand the risk level of the company. I gave you a very easy example, the Government of India, Reliance, X Limited and all. In reality, when companies issue bonds, there will be credit rating agencies. A company, whoever is issuing bond, that fellow voluntarily goes to credit rating agency. Sir, please rate us, and he will ask, he will get the rating done. Our rating he will put in front of the public. See, sir, this is my rating. I want money, please give money. In this, the company itself is communicating to the investor about his risk level, so that the investor will be able to make a decision about how much required return they should expect from this particular company or from this particular bond or debenture. ఆ రేటింగ్ ఏజెన్సీకి యూ విల్ నాట్ గో యాజ్ అన్ ఇన్వెస్టర్. కంపెనీ వాలంటరీలీ గోస్, దే గెట్ ఇట్ రేటెడ్ అండ్ దెన్ ఓన్లీ దే కమ్ అవుట్ టు యూ. Sir, without doing credit rating, if anybody comes and asks you money by offering debentures, why will you touch that? You will not pay. You will not buy them. So issue will be a failure. So compulsorily credit rating, they will get it done. So where are we discussing? We told that fair value of any bond, bond valuation means computing the fair value of the bond. Bond is nothing but a debenture. Ee bond ka real worth, how will I know? What you have to do is, take the bond cash flow. What type of cash flows bond pays? Coupons it will pay, maturity value it pays. E coupons, maturity value, everything you discount it to today. Using which return? Required return. Whatever present value lump sum amount you are getting, that only is called as the fair value of the bond. Suppose, sir, you used a required return of, let us say, 18%. Coupons are interest amount, sir. All this interest, maturity value, all this you discounted. After discounting, present value, let us say, you got it as 125. A present value, I am giving a name. Which name? Fair value of the bond. Sir, what is the interpretation of fair value? Interpretation of fair value means, if I want to earn a return of 18%, today I should buy the bond at rupees 125. That is the meaning of fair value. This is exactly similar to yesterday's discussion. A project is giving me 10,000. I want to earn a return of 10%. So you should buy the machine at 24,869. Sir, is the market price of the machine 24,869? I don't know. It may be, may not be. Like that, this bond ka real market price, I do not know. What I know is, how much I should pay, I can calculate. Market lo what number is there, how will I calculate? I have to go and check in the market. Sir, market price, no. Adi market lo available, sir. There is nothing to calculate in that. You just go and see what is the price in the market. What I can only calculate is, how much can I pay for this bond, that only I can calculate. Ade fair value of the bond. Okay. Now, e fair value of the bond lo, coupon ante interest amount, sir. This bond is specific. The company only will tell you how much coupons they will pay, how long they will pay, how much maturity value they will pay. Now we are discussing how to determine this RR. RR is required return. Required return depends on two things: riskiness of the bond and market interest rates. Riskiness in the sense, if you are investing in a bond which is very high risky rated, then in that case you expect a higher required return. Low risk, low required return. Now coming to the other part. Sir, how come market interest rates impact bond valuation, or market interest rates, how are they impacting my required return? Let's see. So, a very fundamental basics, sir. Easy only. Listen. Sir, market low risk-free rate is 8%. Imagine. Our boy is investor. He is having money. He wants to invest it somewhere. Suddenly he observed Reliance Industries is coming out with a bond issue. A bond they are issuing at par value of 1,000. Face value, par value, nominal value same only. Coupon rate, what they are offering is 12%. The life is 5 years. Redemption also is at par. So today you give 1,000. Every year they will give you 120, 120, 120, 120, 120. 5 120s they will give you. After 5th year, they will give you your 1,000 rupees back. Game over, sir. Now can you tell me, if you buy this bond, how much return will you get? Exactly. You will get exactly a return of 12%. Now, whether I will buy this bond or not depends on what is my analysis of required return of this company. Is Reliance Industries risky company or not? Risky. Tell me, sir, will I expect 8% or more than that? More than that. So what our fellow thought is, today market lo risk-free rate is 8, but e company is not risk-free company, it is risky company, so I want extra return, and he added 4%. So that came to how much? 12%. I want a return of 12% from this company, and he decided, and he looked at the company's bond. Wow, fantastic. E company is also offering a coupon rate of 12%. I want 12, company is giving 12. Will I buy the bond or not? Will buy. So happily, our fellow on the first day, he is a proud owner of bond. He purchased bonds, sir. I am telling you once again, his required return is 12%. Coupon rate and the interest rate on the bond is 12%. They both matched. This fellow happily bought the bond. 1 week over, sir. Exactly 1 week. Government decided that India's inflation rates are increasing crazily. Therefore, we also should increase the risk-free rate. And they increase the risk-free rate to 10%. Government is giving interest rate of 10% to its investors, sir. Government if you invest. Now you tell me, sir, are you investor in government? No. Sir, I am investor in that person who is running the government. No. You should think like that. You are investor in RIL company, sir. Now, my question is simple, sir. What is your required return now from RIL? Will it be still 12? Will it change? Why will it change? Sir, earlier 12 I computed by adding 4 to the risk-free rate. Correct? No. But today risk-free rate changed. If risk-free rate changed, my revised required return will be equal to not 10, right, 10 plus extra 4 I want, which is 14%. Now, tell me, sir, will the company pay me 14% now? No. Company fixed the coupon rate at 12, but my required return is 14. Now you tell me, sir, our boy is happy or sad? First day he was a proud owner. Now he is a sad owner. Why is he sad? I want a return of 14, but the stupid bond what I purchased already, that will deliver only a return of 12%. I am not happy, sir. What will I do? You will sell the bond now. You will sell the bond. Why? Why, sir? I bought this stupid bond thinking that it will give me 14%, sorry, 12% once upon a time. At that time, my estimation was 12 only. He was also giving 12. Today, my demand changed. My RR is 14, but this bond continues to give me only 12%. If bond is no more satisfying my expectations, I don't like to hold this bond, sir. I will sell the bond. Fantastic idea. My question is, who will buy? Why will he buy? Sir, I bought a bond, sir. No, sir. I bought a bond. Now I am selling because a bond is giving me a return of only 12, but I want 14. I am selling this bond to you. I am offering it to her. Tell me, sir, won't she also think in the same way? Today market low rates have increased. So considering today's return, she also wants 14% from this bond, but a stupid bond with the coupon rate is given as 12. My question is, you told me to sell the bond. I will sell the bond. But why will she buy the bond? Good. Very good. Now, sir, you are very sad. You want to sell the bond. You found one more investor who wants to buy the bond from you. You purchased this bond at 1,000. You offered, alright, take this bond and give me 1,000 rupees. Will he give you 1,000 rupees? Huh? No. He will definitely give you something less than 1,000. Let us say he gives you 970 rupees. You found 970 rupees interesting, you sold the bond. So you are now happy because you sold the bond, but in fact you actually suffered a loss. Why did you suffer a loss? 1 week back only you purchased the bond at 1,000. Today you have to sell it at 970. You are feeling a loss of 30. My question is, this boy who purchased the bond, how much return he will get from this bond? Good. He will get 14% return. How? Sir, a bond still carries a coupon of only 12%. And a bond is ultimately, its maturity value is how much? 1,000. But you must realize, this fellow today purchased the bond only at rupees 970. He is not just getting the coupons. This fellow is having a capital gain also. How capital gain? Purchased at 970, ultimately getting 1,000. There is a 30 rupees extra gain also, no? So he coupon 12% plus this capital gain, all put together, this fellow will manage to earn a return of 14%. This fellow is suffering a loss. Like this. This is how bonds change hands, and when bond change hands, one fellow will be losing, one fellow will be gaining. Sir, why should I sell the bond? Apart from reasons like I want money, sir, apart from that, the reasons for selling the bond is, when the bond is not capable of giving you your required return anymore, you should not stay there. Get out of that, take this money, park it somewhere, whichever gives you your desired required return. E risk I want 14, but I won't get 14, I will get only 12%. So you sell the bond. Sir, then why is he buying? He is buying because he is getting 14. Sir, why is he getting 14? Because I am by selling the bond at a cheaper rate. Sir, what if I don't sell the bond at cheaper rate? He won't buy. Nobody will buy. Not you, sir. Many people who purchase the bond like you, they all are unhappy only. You are not just alone in this. There are so many investors who are unhappy now. Our Reliance fellow already knows that interest rates are going to increase. Wantedly, 1 month back only he issued bonds at a particular rate. He cheated us, sir. I feeling everybody will have. Now everybody wants to get out. If so many sellers are there, what will happen to the price of the bond? Falls. It falls. It royally falls. Our job in this chapter is to calculate those prices only. A price, initially when I am buying, at what rate I should buy. If somebody is selling, should I buy or not? If you are only selling, at what rate I should offer to sell? Discussion say chapter is all about. Sir. The chapter is all about bond price ka movements. Why they are coming, how to compute those numbers, decisions to be taken on the bond. This is all this chapter is about. So anyway, going back to our principles, here we are standing. Tell me, ultimate point only I forgot. Why did your RR change here? Company ka risk increased. Company ka risk is same only. If company risk changes, definitely RR changes. But here my RR changed not because of company's risk. Marketly interest rate increased, my demand also increased. If marketly interest rate would have decreased, my RR also would have decreased. Now you tell me, sir, your RR depends on what? Market interest rates also, risk also. If any change comes in the risk, bond price fluctuates. Market interest rates no fluctuation comes, bond price will fluctuate. Sir, government risk-free interest rate, if they change, why will Reliance bond price fluctuate, sir? Why means, if risk-free rate changes, investors' required return changes. If investors' required return changes, the existing bond will no more be catering to their required return. So people will not like to hold the bond. They may sell the bond. When they sell the bond, the other party will not buy the bond unless you lower the price. That is the reasons bond prices fluctuate. Everything is interlinked, sir. I'll give you another example. You issued, Tata Motors issued a bond. This bond ki A rating they gave, sir. A rating. Some credit rating company has given A rating. For A rating in India, your expected or required return is 12%. Let's say a company also offered 12%. Happily you purchase the bond. After buying the bond, this company ka rating fallen down, sir. Possible or not possible? After you purchase the bond, company ka performance has fallen down. Slowly its risk increases, your required return also. Once upon a time 12. After 2 years it may not be 12. It can be 14 also. It can be 18 also. It can be 6 also. I don't know. So why will required return change means required return changes because of risk factors of the company or because of the market interest rates. At the end of the day, we have only two ingredients which will dictate bond price. One is right hand side lo required return, left side lo bond future cash flows. This will never fluctuate, sir. Will this fluctuate? How much coupon amount you will receive every year? Will that fluctuate? Adi constant ఉంటుంది, sir. Life constant. Maturity value constant. So if at all your bond price is changing, the culprit is this fellow only. Bond price fluctuates mainly because of required return only, and required return fluctuates because of riskiness of the bond and because of the market interest. This is the core part of bond valuation, sir. over. Now we have to do some questions and get more clarity on what you have learnt. That's all. Now before we go into the questions, some theory is there in the material. Let's together read that. It will be a kind of revision for us, and then page number 74 or 5? 74. Yeah, read, sir. From the beginning, all the points. People have come late. Please focus on all these points, sir. You have missed nothing at all if you understand whatever we are reading now. Please read. Two common sources of raising funds are equity and debt, for whom company can raise money either by equity or by debt. Issue of a debt involves a fixed commitment every year in the form of interest and usually repayment of principal amount at the end of specified period. You make borrowing, then you will have interest and principal commitments. Now what is bond? Bond is a debt instrument in the form of securities issued by corporate companies or government by raising funds. So not by, sir, for raising funds. Brackets, right? Bonds is equal to debenture. They both are same only, sir. No difference at all. Bond, debenture, both are same. On these bonds, the issuer issuing company, the issuer has to pay interest each year. This interest amount payable is also called as coupon amount. After that, put a full stop. The interest rate is referred as a coupon rate. Whatever interest the bond pays or debt pays, debenture pays, you should not call it as interest per se. You should call it as a coupon amount. Interest rate on the bond is called as coupon rate. Like shares, bonds also will have a defined face value or nominal value. This face value is the amount on which coupon rate is applied to compute the interest payment each year. The bonds public debentures issued may be redeemed at par, premium or discount. After that, add one line. This I told you already. If the question is silent, assume maturity value is equal to par value. Par value and face value. That only is nominal value. Because you can't assume otherwise. Because if you say that I believe that bonds are redeemable at premium, and if you assume how much premium, and I'll ask you. You don't have answer for that. Discount also same thing. Next. As the chapter name is bond valuation. Now what is bond valuation? Bond valuation is a process of computing the fair price of the bond. The fair price of the bond is also called as theoretical value, intrinsic value, equilibrium value. This is the value at which investor can earn his required return. Please underline that point. You should not misunderstand that whatever fair value you are computing using your calculator, pen, paper and all, that is not the market price of the bond. That's not market price. How can you compute market? What price is there in your home? What you are computing is a fair price or fair value. It is the rate at which you should buy the bond if you want to earn your desired required return. That much only I can tell you. Real market price, why will I calculate, sir? It is already there, now I will go and see. Next. Fair value of the bond is equal to present value of future cash inflows from the bond discounted at required rate of return. Bond valuation depends on future inflows and RR. Future inflows and interest amount and maturity value. Required return depends on risk and the market interest rates, as we just now discussed. Then I gave you formulas, sir. Coupon paying bond. Coupon paying bond means a bond which is giving interest every year. So 1, 2, 3, 4, 5 years it will pay interest. 5th year ending it will give us maturity value. How to get the value of this bond? Discount everything to today. Since all the coupon amounts will be same, that is a annuity cash flow. So I am multiplying it with annuity factor. Maturity value is a single period cash flow. So I should multiply it with PV factor. PV IF I have to multiply. Next. Come to the zero coupon bond case. Zero coupon bond, as the name itself indicates, it does not pay any coupon. Sir, if it does not pay any coupon, why will I buy the bond, sir? You will buy the bond because the bond is issued at discount and it's redeemable at par value. or whatever maturity value they tell you. So just to discount the maturity value. Maturity value is a single period cash flow. Multiply that with PVIF. Then comes the third scenario of a perpetual bond. Perpetual bond means a bond ka life is unlimited, sir. It pays on coupons for unlimited period of time. Sir, when is the redemption, sir? No redemption. Whenever company dies or liquidates, at that time they will pay. Now, when will the company close down? And do we have an answer for that? No. So we have to believe that for infinity period, the company will continue to exist. So coupons for infinity period are there, all that you have to discount. At the level perpetuity cash flow. Level perpetuity cash flow, what is the formula? CF1 divided by PIR. Because CF ante interest is our, PIR is your discounting rate. So interest amount divided by RR only will be the fair value of the bond. Then I wrote 2 note points, sir. They are very, very, very important. Extremely important. Please mark it first and later on read. The price calculated above is the fair price or theoretical price. It is a price at which bond should be purchased in order to earn the required return. The actual market price of the bond may or may not be equal to the fair price, sir. I printed as bond price. Please correct it. Cut the word bond, right? The market price of the bond may or may not be equal to fair price. Therefore, a bond can be correctly priced, underpriced, or overpriced. My computation tells me that I should pay 925 rupees only for this bond. Market la bond price is 910 only. Am I happy or sad? I am already willing to pay how much? 925. Are they available only for 910? Cheaply available now? That only we call it as underpriced. If it is available at 940, more costly it is. Overpriced. Coincidentally available at 925, perfectly priced or correctly priced, like that. Then one more point. In some questions, no, what they will do is, they'll give you bond cash flow, sir. They'll give you RR also. They will tell you, compute actual market price of the bond. Wait there. Bond cash flow somebody gives you. RR they give you. When you discount it, whatever answer you get, that's not called as market price. That's called as fair value. Question that fellow will ask you, compute market price. Sir, then what, sir? See, sir, with the available information, what you can compute is only the fair value of the bond. Compute that only and call that only as the actual market price. Sir, how can you call like that? Because I will assume that the bond is correctly priced. Possible or not possible? Our assumptions are. If nothing is mentioned in the question, we have to assume that the fair value of the bond is the actual market price of the bond. That's it, sir. We are done with theory now. To some extent, there is a lot of story to be covered. So go to question number 1. No. I told no already. Read question number 1. I'll talk to your FR faculty, don't worry. Read. Read. Mr. A is willing to purchase a 5 years rupees 1000 par value bond. Sir, he is willing to buy a bond, it seems, having a coupon rate of 9%. So clearly he is telling A's required rate of return is 12%. That is RR. Question is, how much Mr. A should pay to purchase the bond if it matures at par? How much he should pay means, what is he asking us to compute? Fair value. Till now we learnt only one concept, that is fair value. No, obviously he will ask you that only. So do. Do, sir, do. Make 4 headings, sir. Periods, cash flows, PVIFA oblique PVIF at, what is your RR in this sum? 12%. Tell me, sir, what is the life of the bond? So write 1 to 5 and write 5 here. 1 to 5 means first year ending, second year ending, like that for 5 years. Which cash flow is coming every year? Interest, that is coupon you should say. Apply 1000 into 9%. 90. You not show there, of course if you want you can show. 1000 into 9%. Fifth year ending you will get maturity value. If the question tells you anything, write that. Otherwise assume it as par. Question tells you that it is matured at par, which is 1000 rupees. Now get PVIFA 12%, sir. 1 divided by 1.12. 1, 2, 3, 4, 5. After getting 50 years, sir, first write the PVIF factor. 0.5674. Then press your GT. 3.6048. Sir, PVIFA 12%, fifth period. I did like this, sir. But after getting the fifth equal to, I will get fifth year PV factor. I first wrote that near against fifth year. Then I press GT. I get this. I fill up this. In some calculator, if when you press equal to, if it is not working, I told you one technique in time value of money chapter. You can apply that. Or you do this one. 1 divided by 1.10 equal to you press. After that, press into 2 times. After that, normally continue, it will work. Just in case your calculator does not support directly that, then you do this. This will work, sir. 100% this should work. Okay, now, anyway, get the answer here. 90 into 3.6048 and 567.4, that is 891.83. 891.83 is called as the fair value. This is 12%, huh? Yeah, correct. That only I also got. Okay, sir, continue. Sorry, sum is over now. No. You computed your value, but interpretation is more important. So please go on writing. If the investor wants to earn his RR of 12%, he should buy the bond at rupees 891.83. We should buy the bond at rupees 891.83. Now, sir, let us make further cases in this. Case 1. Actual market price of the bond is equal to 891.83. So whatever you computed as fair value and the real market price, they both are coincidentally same. The bond is correctly priced. So when something is correctly and perfectly priced, will you buy that bond or no? Bond. You should buy that bond. Investor should buy this bond. if he buys the bond at rupees 891.83, his actual return will be equal to required return. So you will exactly get whatever you want. That much return you will get. Actual market price of the bond is 875. ई कंपनी का बॉन्ड की आ कैश फ्लोस की आ रिस्क की आई एम विलिंग टू पे 891.83 फेयर वैल्यू बट मार्केट प्राइस ఈజ్ ఓన్లీ 875. The actual market price, which is 875, is lower is less than the fair value, which is 891.83. Market price, actual market price is less. Therefore, the bond is cheaply available, underpriced in the market. If something is cheaply available, you should go and buy the bonds. So investor should buy the bond. If he buys the bond at rupees 875, his actual return, you'll get more than required return. Because your future cash inflows will be same, but your investment amount is reducing. In any return calculation, investment amount is a base point, sir. If investment amount is less, then definitely return will be more. Cash flows also do not change. Case 3. I am willing to pay 891.83, sir, if I want to earn my desired return of 12%. But imagine market low price is 910. If market low price is 910, I feel that the market low bond is overpriced. I should not buy the bond. Bond is overpriced in the market. That is costlier. Investor should not buy this bond. If he buys the bond at rupees 910, then his actual return from the bond will be less than his required return. So first case buy, correctly priced, underpriced also buy, but when it's overpriced you should not buy. I'll give you one more decision in third case. Listen. Sir, you are an investor already holding the bond. You are not a new investor, sir. You are an existing investor. In your hands, bond is already there. You know that the fair value of the bond is 891.83. You also know that in the market, the bond price today is 910. What you should do? You should ideally sell off the bond. Why you should sell off the bond? A bond ka worth 891 hai, but some fool is there in the market who is willing to buy it 910. Just know he bought, some people bought, more people are also there. So before they realize that the bond is overpriced, you go and sell off the bond. Sir, I don't want to sell the bond, sir, I love this bond. Do one thing. You sell off the bond. Like how you sold, many people also may sell the bond. When many people will sell the bond because it's overpriced, what will happen to bond price? Bond price will fall down. And at one stage it will come down to 891.83. At that time again go and buy the bond. So if you see overall, you are selling at 910 and later on buying back at 891.83 in the market. You will still make a gain there. Okay. So write that analysis as well. If investor already holds the bond, he should sell the bond. Guys, if you have any doubt, you may ask me, or else we'll move little further into next concept. There is a sum, sir, but before sum, there is a concept again. The first concept, sir. We'll link it up. Okay. Sir, till now, we were trying to make, the concept is over, sir. Till now, we were trying to make a decision, sir. What decision? Whether to buy or don't buy. Based on what? Based on your comparison of actual market price of the bond versus fair value of the bond. If the bond is underpriced or if the bond is correctly priced, you will go with buy. If the bond is overpriced, you will write the answer don't buy. You may also write the answer sell the bond. Till here clarity is there? Sure? Okay. Should I spoil it now? I'll try my best. You also try your best. Tell me this, sir. Actual return is less than required return. Bond is, fill in the blanks, underpriced or overpriced? Price I will not tell you. Look at returns and answer. I am getting less than what I want. That happens only in one case. Which case? Overpriced. If your actual return is more than required return, you will get more return only when you make a cheaper investment, sir. Cheaper investment means you are buying the bond at a price which is less than its real worth. So the bond should be underpriced. Okay, from return angle also you should be able to analyze. Okay, listen. Now, sir, I will show you some numbers and examples. You not write anything, it's already there in the material. But before you read that and get confused on your own, one small caution, sir. Whatever I am going to tell you now, in the three cases I am going to tell you, all three cases, I am already telling you the bond is correctly priced. What is the meaning of correctly priced? Its actual market price is equal to fair value, and therefore actual return from the bond will be equal to required return, and the answer is you should buy the bond. So whatever discussion I am making from here after, for the next 10-15 minutes. I'll show you some examples, I'll work out some numbers. In all the cases, whatever I'm going to discuss, the answer is already fixed, sir. You have to buy. You have to buy because the bonds are correctly priced. Then what am I trying to establish now is, I'm trying to establish a relationship between coupon rate is the interest rate on the bond, and the required return on the bond. And what impact this relation will have on the price of the bond. ఈ త్రీ correlations are coupon rate, required return, bond price. ఈ త్రీ కి one relation I will establish now. ఆ relation లో 3 cases will come. ఈ 3 cases లో what you have to primarily understand is, you should not say, sir, buy the bond, sell the bond and all. We are not taking any decision. Decision making will come into picture when fair value and actual market price, they both are not same, then decision will come. When they both are already same, what decision will you take? The answer is always buy. Okay, now the 3 cases we will see. Go to the theory part, sir. Next concept, whatever we have discussed, subsequent concept. I think that is there in page number 77, sir. Please take up 77 page. Okay, 77 page lo one example is given, sir. You open that example and you watch as I am solving. You will not solve, I will solve. You can check the numbers or you can give me answers from there. Sir, listen. They have taken a bond, sir. E bond ka face value or par value or nominal value, he has taken it as 1000. Life, I think they have taken it as 5 years. Coupon rate, they have taken it as 10%, sir. Ivi bond characteristics, ivi fixed. Now there are 3 cases he is taking. Case 1, your required return is also equal to 10%. Coupon rate is 10. Investor also wants 10. That means it is a scenario where your coupon rate and required return, they both are same and same. In this case, I want to try and work out bond value, sir. Now, bond value, how to work out is normal only, whatever table you have drawn earlier, same type of table. Period, cash flow, PVIFA oblique PVIF. Tell me, sir, I should discount at what rate? Quick. 10 or any other number? 10. E 10% is which 10%? Very good. Is required return 10%. So PV of cash inflows. Bond life is 5 years. 5 years. Coupon rate, since it is 10 into 1000, 100. Here it is 1000. 10% discounting factor, annuity factor, sir. 5 years if you work out, that will give you 3.7908 and this will give you 0.6209. If you do the math, ultimately you will have 1000 rupees as the answer. Don't work out, it will be 1000 only. Now what is this 1000? The result is what? First answer, this is fair value of the bond. But what did I tell you? Bond is correctly priced and I told, correct? Since bond is correctly priced, this is also the market price of the bond. They both are same only. Sir, will I buy or will not buy? A question will not arise because you will definitely buy the bond because the bond is already correctly priced. Clear? Now what I want you to observe is, a bond, a bond is trading at par value. Trading at par value means bond market price and bond ka nominal value, they both are same. That means if an investor has to buy this bond today, he will buy at what rate? 1000 rupees he will buy. He will hold the bond for how many years? 5 years. At the end of 5th year, what will he get? 1000. Is any capital gain? Capital loss? No. So the only return what he is earning is coupon. And coupon ka rate is how much? 10%. That's all. His actual return will be only 10%. His required return is actual return, and our return is coming entirely in the form of coupons only. Sir, what about maturity value? He will get maturity value, but maturity value gain will not be there. Why? You invested 1000, you are ultimately receiving also 1000. In case so there is nothing much to discuss, sir. Bond will trade at par value. That's what you have to remember. When coupon rate and required return both are same, bond will trade at par value. This is observation, sir, which you have to remember now. Case 2, sir. Case 2 lo, what is the RR? I took 12. RR 12% I have taken, which means your coupon rate is less than RR. Investor wants 12, but your stupid bond will pay only 10. Sir, in this case, what will happen to price of the bond? And we are trying to analyze 1255. Cash flows will not change, sir. Coupons, maturity value will not change. My discounting rate will be based on my required return, which is 12%. This should be 3.6048 in 0.5674. Just now we did the previous sum. Present value of cash inflows. Tell me this number. Final answer, sir. 91. That's all, that's enough. 928. Now I ask you, what is 928? Again, same answer. 928 is a fair value, okay? But I told you the bond is correctly priced. Correctly priced or not? Yes. Ante sir, this is also the market price of the bond. Tell me this. Will you buy the bond or no? Will you buy the bond or no? Sure. Bond correctly priced or underpriced? Sir, bond is underpriced or correctly priced? Bond is perfectly priced. Why? Fair value and market price both are same. But the bond is lesser than the par value. What is the par value of the bond? 1000. Bond market price is 928. That means a bond is trading at discount to the par value. So what you have to observe is, whenever coupon rate is less than required return, the bond will be trading at discount. Discount unte cheap gaad, sir. That's what you have to catch. Cheap, and when I will say is, when the market price of the bond is less than the fair value, appud cheap, sir. This is not cheap. Now you tell me, if you buy the bond at 928, if you are the investor, how much return will you get? 12 or 10? 12 or 10? Our conclusions in the first sum, go and read the first sum, first case 1 ka answer once. All of you read. Forget about stupid coupon rate. Case 1, question number 1 ka conclusion you go and read. If actual market price and fair value, they both are same, we say that the bond is, when the bond is correctly priced, investor should, if you buy a bond which is correctly priced, your actual return will be equal to your required return only, no? So E-sum law also it's correctly priced, no? Here also you should buy, no? So your actual return also will be your required return only, no? Required return is how much? My question is, when bond A pays you 10% coupon, how can you earn 12%? Company pays a coupon of only 10. How the hell can you earn 12% return? But that the answer is, company pays 10% coupon, agreed. But your return is not just coupon. Your return is coupon also, capital gain also. Why capital gain is there? You did not buy the bond at 1000. You are buying the bond today at 928. And ultimate maturity will get at 1000. Is there a gap or not? A gap will give you extra return, sir. Overall, coupon also you will get. Capital gain also you will get. Overall, your return will be your RR only, which is 12%. Okay. Now, sir, show, sir, how 12% return is coming numbers though. That I cannot show you now, because that return is not simple return. It's a compounded return. I will definitely show you once we understand how to compute yields from the bonds. The IRR, sir. Basically, we have to see that. Okay. Next. Case 3. Sir, this will not be first time if you are understanding, you are abnormal, sir. There will be some little confusion left. We will remove that confusion. Don't worry. Just go on following to whatever extent you can follow. Third case, I took required return of 7%, I guess. In this case, your coupon rate, my required return is, coupon rate is more than your required return. If you try here, valuation of the bond, 125, 5th year, 100, 1000, I think it's 4.100. How much is the annuity factor? 1.07, 1, 2, 3, 4, 5. 0.7129 and 713. I'll leave it. Final answer you tell me, ma. 1123. What is 1123? This is a fair value of the bond. This is also the market price of the bond. Tell me, sir, bond correctly priced or underpriced or overpriced? Correctly priced. When it's correctly priced, will you buy or will not buy? You'll buy. If you buy a bond which is correctly priced, how much return will you get? Your actual return will be equal to your required return. What is your required return? 7%. So you will get a return of 7%. My question is, when bond is nicely giving you a coupon of 10%, how can you just get 7% return? You are buying the bond at a premium, sir. 1123 you are buying, maturity date you are getting only 1000 back. 123 rupees gone. Capital loss is there. So he handed the 10% you will get. Here capital loss is there. Overall put together you will earn only 7%. Are you getting this? Here the observation what I want you to remember is, when coupon rate is more than required return, the bond will be trading at premium to the par value. The bond will be trading at premium to the par value. Now, there are two discussions we made today, sir. One is whether bond is correctly priced, underpriced, overpriced. That is one discussion. The other discussion what we just now did is whether the bond trades at par, premium or discount. Now, the second concept what we just now learned, if I summarize this in a small table, we will have three scenarios, sir. Coupon rate is equal to required return. Coupon rate less than your required return. You want higher return, but bond is not paying that much of interest. Bond is paying higher interest than what you want. In this case, first case low, bond will be trading at par value. When you, sir, I want some return. Bond is also paying the same return coupon. So, price low, gain gani, loss gani will not be there. Capital gain will not be there. Capital loss will not be there. If that has to happen, the bond should be trading at par value. That only happens. Next. I want 12. Coupon is 10. Sir, I don't care what the coupon is. I will get what I want. I want how much? 12. But company pays coupon of only 10. Our remaining 2 also I will earn. How? In the form of capital gain. If I have to earn a capital gain, the bond price should be less than the maturity value or the par value. That is nothing but the bond will be trading at discount. Last case. I want 7. I want 7. Company pays coupon of 10. No matter what company pays, I will ultimately earn what I want only. That means, when company is giving 10% return, I will get only 7, when the company's coupon rate is 10%, I will get a return of only 7%. Sir, what happened to that extra return, sir? 3%, where did you lose it? I will lose it in the form of a capital loss. Tell me, sir, capital loss ravalante, what should happen? You should buy the bond at a higher price, and maturity low you will receive a lower amount. Maturity, since it is par, today you should be buying at an amount higher than par. That only your bond will be trading at premium. Okay, now where confusion comes is, we people mix underpriced, overpriced discussion, par, premium, discount discussion, create a new concept. One sum lo, one understanding. Ultimately, after 10 sums, you realize that things are not working. Each chapter is gone. Let us take holiday for remaining 2-3 classes. And next chapter ke freshly vachadam. Will not work. I'll tell you now. Sir, confusions will be there, sir. Concepts are not easy. See a final level, sir. The international level concepts. Whatever you are doing, you take any international course, you will find the same concepts. Things will not be smooth in the first go. But you have patience, willingness to learn, it will come. Now see here. Sir, overpriced or underpriced or correctly priced. This discussion is there, no? Is it cheaper, costlier, correctly priced? This discussion is based by comparing good actual market price versus fair value. Whereas whether the bond is trading at par, premium, or bond whether it is trading at discount, this decision or this observation is done by comparing coupon rate versus the required return. Here we are making a decision whether to buy or don't buy or rather sell. Here we are not making any decision. Are you understand? So they are completely two different things, sir. One is for decision making, the other one is just for observation. This is just an observation. So the observation only, no sir. Can we leave this, sir? Unnecessarily this is confusing. No. If it is something you can leave, I would not have taught only. No. It's required. It's required. When you go further deep into the chapter, there are some questions where data directly will not be given to you. A language you have to catch and apply all these principles and bring out the data. So theoretical chapters, numbers will be small. Theory important. Okay. Now, let's make all our efforts to get confused. Sir, there is a bond. E bond face value is 1000. Market price of the bond is 1023. Fair value of the bond is 1100. Don't rush to the answer. Read the numbers carefully. How I got this, from where I got this, and think. Once you see that, I have my question. Peacefully answer. There is no hurry, no first prize for correct answers. So just think and answer. Tell me, is the bond underpriced or overpriced? All of you, sir. Bond underpriced or overpriced or correctly priced on a decision you will take by comparing what and what? Actual market price and fair value. Tell me, sir, actual market price, is it less than the fair value of the bond? Yes or no? Yes. You should compare these two, and you compared. You can see actual market price is cheap. Therefore, the bond is underpriced. Tell me, sir, is the bond trading at par, premium, discount? I am asking, is the bond trading at par, premium, discount? Sir, par, premium, discount, and how will you decide, sir? I am not giving you rates, sir. Look at there. What is the face value? 1000. What is the price of the bond? Price of the bond is 1100. 1023. Market price is more than face value, less than face value? More than face value unte discount antara, sir. Mee ullo premium. Observe now, sir. First example A, clarity should come or confusion should come. Sir, oka side underpriced, sir. At the same time I am saying it is at premium. Underpriced and I am telling by comparing with what? Fair value to compare market price and fair value. Premium and I am telling that by comparing market price and face value. Now, decision is buy or sell? Decision is buy or sell? Buy based on what? Premium or underpriced? Good. Therefore, buy. This is not for decision making, just observation. Are you getting it, sir? I compare face value, market price to see whether the bond is trading at par, premium, discount. But whether it trades at par, premium or discount, that does not impact my decision making. I am only bothered about, sir, adi par kunte nakenti, premium kunte nakenti. I don't care. What I want is, am I getting my required return or not? That I will know by comparing actual market price and the fair value. Not by comparing coupon rate. Sorry, not by comparing with the face value. Okay. First one, I hope this adds some clarity. Let's try another one. Fair value of the bond 1200. Actual market price of the bond is 1100. Face value 1000. Tell me, bond is trading at par or premium or discount? First easy question. Bond is trading at par, premium, discount. Premium or discount? Sir, par, premium, discount ki you need not come to final. IPCC lo shares are issued at par, shares are issued at premium, shares are issued at discount. Bonds issued at par, premium, discount. You know this concept already? Now discount, premium, par, and how will you know? By comparing what and what? Market price and face value. Face value, sir. I wrote face value here. So the bond is trading at premium. Okay, now tell me. Bond is overpriced or underpriced? How did you know? It's worth 1200. Market lo cheaply available at 1100. Therefore, the bond is underpriced. Will you buy or not buy? Buy based on premium. Above case, this case, both are same, sir. I just place change. Anyway, still you gave correct answer only. Let's try something new now. Okay. Face value of the bond 1000. Actual market price is 900. Fair value is 925. First one, bond trading at par, premium, discount. Sure. Pakka, something less than par means that is at discount. But tell me, if it is discount, does it mean that it is cheap? No. Premium ante, does it mean it is costly? No. Good. Is it discount? The bond is definitely trading at discount. Tell me, bond is overpriced or underpriced? Why discount and underprice both are same, Anna? No. It's a pure coincidence that discount also is there and luckily bond is also underpriced. You will definitely buy the bond. Cheaply available means it should be less than the fair value, not face value. Face value kante bond price if it is less, I will say that bond is trading at discount, but that does not mean that the bond is cheaply available. Whether it is cheaply available or not, that I have to compare with the fair value, not with the face value. Let's try another one. This time you are gone, sir. Fair value 900. Actual market price 930. Face value 1000. Bond is underpriced or overpriced? How do you know? Your actual market price is more than the fair value. It's trading at a price more than its worth. When it is like that, we say that the bond is costly or overpriced. Buy or don't buy? Buy or don't buy. Don't buy. Okay, next. Actual market price and face value compare. Tell me, bond is trading at par or premium or discount? Discount. Bond is trading at discount. From this you must at least realize that just because bond is trading at discount does not mean that it is cheap. Cheap and we will buy. No. Asal cheap and a discussion will not come when you see discount. Discount is a decision made by comparing face value, sir. Face value and market price. Cheaper, costlier, correctly priced, adi different concept. For that you are comparing fair value and market price. I hope little clarity comes. Tell me, sir. A bond is trading at premium. Will you buy or will not buy? You can't answer. You should not answer. Bond is available at par value. Should I buy or should not buy? Bond is available at par value, sir. Should I buy or should not buy? You can buy. Let's see and decide. Fair value 900. Actual market price 1000. Face value 1000. Bond nicely available at par value. Kani overpriced. Why overpriced? Fair value 900. It's worth 900 in range 900, but you are trading at 1000. Overpriced. You may be at par, you may be at premium, you may be at discount, but that doesn't mean that I will buy you. Whether I will buy you or not is a decision by comparing fair value and the actual market price. Sir, are you all understanding something? Sure. That's all. So guys, that's all for today's session, sir. Tomorrow we will continue.